Good morning. Welcome to today's episode of Real Estate Secrets You Need to Know. On my real estate channel, I like to provide the education, information, and resources you need to make the best decisions you can regarding your real estate purchases and personal finance. We have a special treat today. We are here with Mr. Rafael Jimerson, who is with New York Life, and he is going to give you all the scoop on how you can make the best financial planning decisions for your family and ideally start off with a boost for your generational wealth. So as you know, buying real estate is one of the biggest assets that one can purchase. And as I mentioned, it is one of the ways that families create wealth for generations to come. So we hope that you are encouraged and inspired to purchase a real estate property for yourself and who knows, perhaps for an investment opportunity. There are also several other ways you can get involved in real estate if you want to wade in slowly. And I will endeavor to remember to put a nice download in the description box called 5 Alternative Ways to Invest in Real Estate. So with that said, let's get started with today's guest. Welcome, Rafael.
Thank you, Larissa. I appreciate you having me on today.
All righty. So now we know this is not the topic that we talk about around the dinner table, but we think that it should be a topic that you talk around the dinner table and talk with your family members. And we hope to take some of the mystery out of how you can protect your hard-earned assets and also plan for your family's future should something untoward happen, as we say.
Right.
All righty. And so many good questions. I'm not sure where to start, but how about, I know the names can be a bit confusing. So what are some of the different types of life insurance one should buy?
That's a great question. So the different types of life insurance you have is temporary insurance, you have permanent insurance. So temporary insurance would entail, it could be for a year or it could be for a level term, which is for 10, 15, or 20 years. So within that time frame, your premium would never increase, but you would have guaranteed death benefit protection. So meaning within that time frame, God forbid, if you don't wake up tomorrow morning, the proceeds from that policy will be paid out to your beneficiaries. Well, also because it's for a specific time frame, if you happen to outlive that term policy, the premiums will continue to increase yearly or annually the longer you keep that plan. Then you have permanent insurance. So permanent insurance, you're pretty much owning that plan. So it could be whole life insurance, traditional whole life insurance. It could be custom whole life insurance. So traditional insurance, you're going to pay into that plan to age 100, which is going to cover you to age 100. Your premiums never increase within that time frame. And also you'll be eligible to receive dividends. So, and then also you'll also be able to build cash value inside that policy. So with the cash value, what's feeding that is going to be the premiums that you're paying into the plan. And depending on which carrier you're with, the whole life insurance will be eligible to receive dividends, which means there's a portion of the profit that's being cut from the insurance company that you're doing business with. So that's going to give you, again, a guaranteed death benefit protection. It's going to build a long-term savings plan as well. Your money is going to work for you while it's growing on a tax-deferred basis, and also to allows you to access that cash value on a tax-free basis via policy loans. And then another aspect of permanent insurance would be universal life. Mm-hmm. So universal life is different from whole life, meaning with whole life insurance, your premiums are going to be, your cash value is going to be built based on the premiums that you're paying into the plan and the dividends that's being put into the cash value as well. Now with universal life, the way it builds cash value is not only through the premiums that you're paying into it, but the insurance carrier has a general account which they use, which consists of a portfolio of fixed income investments. So these are going to be like your bonds, municipal bonds, and the interest rate that they receive on those investments, they credit you in your universal life policy, and they credit that to your universal life policy. And also it gives you a little more flexibility as far as you don't have to make premium payments every single month. So those are the different types of life insurance policies.
So that was a lot of information. So I do want to remind you that Rafael will be available to answer some questions because I'm sure you're going to have probably 1 or 10. So because there are some additional benefits to the different types of policies and different ways to Well, as he mentioned, I mean, this is not the first thing you want to think of, but there are ways to otherwise access the funds if needed, if necessary, if something changes in your life. So anywho, that's not my department. Like I said, Rafania will be available to answer questions afterward. So given that, those descriptions, now it was interesting that you called it temporary insurance, which I had not heard that term, but I understand. I'm familiar with the word, term policy. I understand that. But I also didn't know you could buy one for, as little as 1 year. So that is fascinating. I would at another time want to know why someone would do that. But anyway, good intel. So all that said, what are some reasons that one would choose either temporary term or whole life universal coverage? What would be some reasons one would pick one or the other?
Yes, it's always dependent on your situation. So, for instance, if you're, let's say, for example, if you're single, you don't have kids, you're pretty much renting, you pretty much rent right now, you don't own your home, or you could possibly own your home, and you may not need you may not have a coverage need where you need to have a permanent policy where you're paying a couple $100 into it. You just need enough coverage to last you for that year, and you don't want to pay. You may have a $10 or $20 or $15 budget. So a temporary policy would make sense for you in that moment. If you're looking to for a whole life policy, this may be for a person who's looking to protect their family long term. They want to have some permanent insurance in place. They want to make sure that they don't have to keep paying into this plan year after year. They want their premiums to remain level. And they also want to make sure you create a tax-free bucket, because we know with whole life insurance, you're not paying taxes on the gains, and you're not paying taxes when you access the money as well. And then also with universal life insurance, it's not something that I really recommend for everybody, just because of the separate accounts that's needed with the insurance company. I mostly deal with whole life and permanent insurance, whole life insurance and temporary insurance is mostly what I use for my clients.
Well, I understand that obviously everyone's situation is different, um, and it's a real consideration as far as what exactly you're trying to accomplish. Obviously, that's the bottom line reason that you would want to buy insurance, not just for the death benefit, but there are other reasons that you want to consider buying the policy. But as you say, always based on the person's specific life circumstances and or well, life, family is included in your life. So anyway,
Correct.
so yeah, I can see that being those would really make a difference in the type of coverage that you get. So as a one question that comes up a lot, because when I bought my house this time, and maybe it happened before, I don't actually remember, but I was getting so many that it was standing out for sure. But I kept
Yeah.
getting mailers about mortgage life insurance. So what is
Mhm.
that? Is that
So
something
that
that one should consider?
yes, for us. So we know that when you're purchasing your home, for most people, this is going to be their biggest investment, that biggest transaction that they make in their lifetime. With that in mind, it would make sense to protect that investment. So what that's called is mortgage protection. So mortgage protection, let's say for example, this is usually a level term insurance plan. So let's say you want to create a term policy that's going to be for 15 years or 30 years, however your mortgage is set up. As the years go on, let's say for instance you set up a 15-year policy, right? And you're halfway to paying your mortgage off. Well, that depending on the amount of coverage you need, you may not need that coverage for that time period anymore, because again, you've already paid into it for 15 years, you then paid down the principal. So then there would be a need for you to drop that coverage. So you want to make sure you want to start another 15-year plan to cover the rest of the mortgage plan. So that way, once you get to that end, and you happen to outlive the policy and you've paid your house off, you would no longer need that temporary coverage. With your home being paid off, then you want to make sure you have your home insurance, obviously, and you also want to have your permanent plan in place, because again, with your home being paid off, you want to make sure you have that additional coverage. So just in case, God forbid, something happens to you, you have again, you add additional money to pull from if you want to buy another home, or you want to use that money to supplement your income when you retire, or for whatever emergency expenses may be. I know that's going on to whole life insurance, but essentially that's what mortgage protection is. You covering your life for that specific time frame of your house.
And that on the mortgage life insurance, that is for that pays the mortgage off to the lender. Is that right?
So what happened is, God forbid, something were to happen to you within that time frame of the term policy, you can set it up to where you can have the proceeds from that policy to pay your house off.
Okay. But on the other hand, is there a particular reason that you maybe have already answered that, but I'm asking you anyway. So again, happy homeowner, they just bought the house. He carried his young bride over the threshold. Honey, we're home. So
right.
So all things being equal, if it's not mortgage life insurance, should one consider, or why does buying a home trigger the need or recommendation, if you will, to buy life insurance?
Again, you want to protect your biggest investment. You want to make sure that, God forbid, if you don't wake up tomorrow morning, will your house be paid for? Who will continue to make those mortgage payments? For example, you may have a married couple, the man or the woman in the house, whoever is the breadwinner. God forbid something happens to that breadwinner, and the spouse is staying at home. If they don't have the skill sets that's necessary to thrive in today's environment, how would the home be paid for? Who's going to continue to make those mortgage payments? So that's why you want to have that mortgage protection in place. So you know that, God forbid, something happens to this breadwinner, I can grieve properly, and I know that my home is going to be paid off moving forward while I'm taking the time that's needed to build the skill sets that's needed. So I either start a job or start a business so I can continue to generate some income.
So also one of the things that, one of the other reasons that people buy real estate, we talk about the personal residence, but there are also people who buy real estate as an investment. So when one is looking at, and we didn't actually talk about this, so I'm introducing a new term. So
go ahead.
You see what happens with this when we run with this, but is there a particular price point? And I say, maybe when I say price point, I'm referring to one's net worth or business assets, where it makes sense to buy a second to die joint life policy.
So a second to die joint life policy, I would only recommend that for people that are married. So if you're single, to me, it wouldn't make sense. It wouldn't make sense for you to have a second to die joint life policy unless you have a long-term girlfriend or a boyfriend who you believe you're going to build a long-term relationship with. But if you're not married, if you're married, in some instances, it could make sense to do a second to die life joint policy. But you can also do what is called, but to make it cost efficient, to do a blended solution of temporary and permanent insurance as well. So depending on the amount of coverage that you're looking for, let's just say, for example, you have $1 million worth of coverage. Permanent coverage, it may cost you $200. The couple may say, look, we don't want to pay that kind of money for this type of plan. Okay. How about we break that cover? How about we do a blended solution of providing $500,000 worth of term coverage and do $500,000 of permanent coverage? That could potentially go from paying $200 a month to $150. So those are solutions that I recommend to my clients outside of doing second to die joint life policies.
So it sounds like what I'm hearing is that one would buy a second to die policy based on the relationship. It's not about how much money you have. It's based on whether or not there's a relationship that you're trying to protect. Is that what I'm hearing?
No, not the relationship you're trying to protect. But I'm saying that if you're married, obviously your goals are going to be different, I suppose, if you're just in a domestic partnership or it's a boyfriend-girlfriend relationship. If you're going to do a second to die life insurance policy, there has to be a conversation that's been made between you two before making that decision by going in that direction. Does that make sense?
It does. I mean, it's just like Google.
Yeah.
We get just enough information to be dangerous. So
right.
I just wanted to get some clarification about why that would be a consideration. So no, that's all good. So I also learned, it might be semi-related, that there are actually different types of underwriting, which is the decision, obviously, how they determine what your premiums will be. So can you talk a little bit about that?
Yeah, the underwriting is pretty much going to depend on the amount of coverage you're applying for, your age, and they're going to take into consideration your health at the moment as well. So again, let's say, for instance, if you're 25 years old and you're applying for, I think, $50,000 worth of coverage, depending on the insurance carrier, they may only, because of your age and the amount of coverage you're applying for, it may only require you to do what is called a phone interview, which is part of this will be like telephone underwriting, where they're just going to ask you if you're into thrill-seeking activities like bungee jumping or skydiving, or if you smoke tobacco or smoke marijuana, things of that nature. So the younger you are, and the more coverage that you're looking for, then the underwriting becomes more not intense, but they're going to do a little deeper underwriting. So it's going to go from a phone interview. They're going to check your medical records. They're going to request a statement from your doctor stating if you're in good health, because they want to verify that the information that you're putting on your application checks out. So that way they can understand how to properly rate you as far as medically, and depending on the type of income that you generate, to make sure you have the right amount of coverage in place.
So, I mean, I guess at the end of the day, in doing the underwriting, the insurer wants to determine the likelihood or how quickly they may end up having to pay out. So this is a method for them to, I guess, protect their
interests.
Thank you.
As you could say.
I just cannot find these words sometimes. Okay. But yeah, it's good to know that there's a different type of underwriting. So, but that's not up to the purchaser, that policy owner, that's up to the insurance company. As to which type of underwriting they do, right?
Correct. So it depends on the carrier that you're dealing with, that you're applying for coverage with. So depending on your health, I can tell you right now, if you have pre-existing conditions like cancer, or if you had a stroke in the last year, a heart attack, if you've had epilepsy, things of that nature, it's going to make it quite difficult for you to get coverage. But there are carriers out there that will insure the risk. So it really depends on your age and the health that you're in as in the present time.
Well, I just want to make sure we repeat that. It's that even if you do have health concerns, you can usually get some level of coverage. I don't know, that might be a Freudian slip, but anyway, right. There are different levels of coverage, and as Rafael mentioned, there are different carriers. So yes. If you get a no, don't be discouraged. Just go back to your broker and keep asking questions. And in particular, again, like I said, or like we said, it also depends on what it is you want to accomplish. I mean, there are people who look at insurance as strictly a death benefit, like what the family is going to get after they pass. But again, like I said, it could also be part of financial planning, in that you want to pay for your final expenses, but you also want to ideally, perhaps, I don't want to say ideally, that's subjective, provide some additional monies for the family. So again, it's knowing what you want to accomplish, and of course your health, but your goals are part of the planning. There we go. Eventually we're going to find that word. So anyway, there are a lot of things that go into why you want to buy real insurance. So make sure that you prepare a list of questions, perhaps, so that you can have the best conversation with your advisor and for the better outcomes. All righty. Absolutely. Now that I tripped all over myself, let's see if we can get back on task. So actually, you may have already said that, but how does age impact the type of insurance that one would buy? I know you talked about the premiums being level when you purchase, say, for example, term and whole life depends on, again, what you buy, but how else does age, or what are the considerations about your age when one is looking at buying insurance?
Age, obviously, the younger you are, the less your premium you're going to pay into it. Always encourage people to start off as early as possible, because depending on the carrier that you're with, the older you are, the more you're going to pay in premium. Also, they're going to take your health into factors as well. So they're also going to take into account if you smoke tobacco, if you smoke marijuana. Again, if you're into thrill-seeking activities as well, again, skydiving, bungee jumping. If you're extreme bike riding, things of that nature, they're going to consider you a risk that they're not willing to accept.
Who has heard
so those
of
are things you want to keep in mind.
So, okay. So again, I guess age is important because the premiums are cheaper, but you can still buy either one, right? As long as you are of legal majority, I suppose they call it.
Absolutely.
Okay.
So the youngest an insurer would cover you was at 15 days old.
Oh my. Well,
Yeah.
clearly the baby didn't sign up, but
Right.
mommy's parents can buy insurance on behalf of their child. And we didn't talk about it, and I don't know if we have time to talk about it, but the person paying the premiums, I suppose, that is the owner of the policy, but not necessarily the beneficiary. That might be getting a little deep, but anyway, is that
yes, that's accurate. They can be the beneficiary as well. So if they're the owner.
I know, but it doesn't have to be. Sometimes there are situations like, for I don't know. Maybe that is the only reason. I'm sure I had a thought back there that went somewhere, but I was because I was thinking about the baby. So the parents buy the policy. I don't suppose they would really pay for. Never mind. That's probably a different type of insurance and way off topic, but I know I had a thought there, but I will probably come back to that.
Yeah, please do.
Okay. So let's see. The other question I wanted to ask, we talked about underwriting. And so my other question is, now that someone has realized the benefits perhaps of buying insurance, how does one go about choosing the right insurance company to work with?
That is a great question that a lot of people don't ask. So there's a few things that you want to keep in mind if you're going to work with an insurance carrier. Number one is obviously going to be their financial strength. How strong are you financially as a company? We know as of last year, there were insurance companies that do have policy holders that do hold whole life policies, and they wanted to access the value and they want to access the cash value for emergency expenses. And those insurance carriers didn't honor those promises that they made to their clients. So that's because if the clients would be able to access the cash value, financially, the company wouldn't be able to withstand such a loss. So that's one thing you want to keep in mind. Number two is longevity. How long has that company been around? How many storms have they weathered? As we know, the pandemic last year froze the world. The world stopped for the first time. We've had the housing crisis in 2008. We've had 9/11. You have just named the list of moments in history to where it's been very volatile. You want to make sure that those companies, the insurance companies that have been around through those time frames, have continued to withstood those storms and continue to be of service to their clients. And then also you want to keep in mind is the additional benefits that the insurance companies offer. We know with life insurance, most people think that life insurance is strictly for death benefit needs only. There's no benefit to you while you're alive. Well, that's quite the opposite. Most insurance companies, they will offer you what is called a living benefits rider. This is a rider. Yeah. So this is a living benefits rider, is a rider that comes along with the policy, which allows you to, if a doctor's diagnosed you with a terminal illness and you have less than 12 months to live, what the insurance company will do is allow you to access up to 90% of your face amount to pay for your medical expenses. So you want to look into those riders and additional benefits because you want more than just death and protection. There's other things that come up. There's other situations that come about down the line. Like again, you may come with a chronic illness that you may not have the finances to pay for. You want to make sure you have an additional bucket to pull from to make sure that it's a smooth transition in case something happens to you. And those would be for three main things I would pay attention to: the financial strength of the company, how long have they been around, and what additional options do you provide to your clients as well.
And how does one find out these inside secrets? How do we find out about the quality of the provide carrier?
What you can do is you sit down with your agent. You can sit down with your agent or your broker or your advisor and ask to see the facts. We're able to, as agents inside the business, we're able to show you how financially strong we are as a company and how we performed as a company since we've been in business.
I was expecting you to say Google, but you're right.
Yes, you can Google.
I know our friend Google gets you in trouble all the time, but it's just so darn easy, right?
Yes, so there, but have your advisor there as well, because that's what they're there for.
You're right. A much better answer. Thank you. Keep me on track. So anywho, let me see. So I really want to probably, I want to say, hammer home the idea
Okay.
that insurance is just one part of financial planning.
Mhm.
Like I said, having a house is a it's a huge benefit to yourself. You have a place to stay, yay.
Mhm.
But it's also beneficial to your family members in that, you know, obviously beyond the shelter, as the property appreciates, you have equity that may, um, you know, assist you when you're planning for retirement. And if you sell the property, you can, you know, that will be added to your bottom line for your um, retirement income. But at the same time, we didn't go deep into it because we were concerned about the time, but we may do a part two to talk about some of the other ways that you can use your insurance as far as the financial aspects. Because again, my point for inviting Mr. Jemison to meet with us today is that it's not just about covering your final expenses. Insurance does so much more because the whole point of life insurance, if you will, is that, and Nathaniel, I'm gonna turn it over to the expert here in a minute, but when you're looking at, say, the amount of coverage that you want to buy, you want to consider how much your earning capacity is over a projected period of time. So you don't just pull the number out of the air, right? You would typically look at, for example, I don't know what your current salary is. If you're making $100,000 and you expect to make another, work for another 20 years. Don't make me do math in my head. I think it's a couple $1,000,000 or something. I don't know. Do the math. But I
Right.
mean, those are some of the things you look at, because if you're not here to earn the income, then you want to make sure that your family continues to maintain the standard of living.
Right.
But maybe if you can, I don't want to get you in trouble, can you talk about how one determines how much they should buy? I mean, yes, you want to pay off the house
Mhm.
perhaps,
Mhm.
or keep
Mhm.
making the mortgage payments, but
Mhm.
you know, again, not picking the numbers out of the sky, because
Mhm.
that's, you know, something I would do. I would just make it up. So we
Right.
don't want to make it up. We want someone to do it the right way. What is the right way
Right.
to choose your level of insurance?
You want to base it either on your budget needs, based on your family needs. So I work with a lot of married couples, and when they don't know how much coverage they're looking for, so I take them through a system where we find out how much are they bringing in after tax, whether they're responsible, and what are their household expenses. So after we find the difference between the household expenses and what they're bringing in after tax, we use that differential income to determine how much they want to contribute for that to protect their financial future. That's one way to do it. Another way we would do it if you have young children. Let's say, for instance, if you have, I'm dealing with a married couple and they have two kids. The oldest one is 15 and the youngest one may be 3 years old. So we'll say we know the 3 year old is pretty much going to be at home till they're possibly 18 or 21. We're going to base the length of their coverage based on their youngest child. How long do we expect this child to be in home? Well, we expect the child to be home, well, at least till she's 20 years old. Okay. So let's design a plan that's going to be based on 20 years and 20 years of coverage. So that way we know that if God forbid something happens to you within that time frame, we know that by the time your youngest child turns 20, they're going to be financially taken care of. We know they can be able to go to the same schools in the same neighborhoods that you want them to go in. We know they're going to be able to live in the same home that you want them to live in long term. But we know we're going to create additional generational wealth as well. So those are a couple of things that you want to that you take into mind when designing your plan, your budget, and based on your children, based on your youngest child, and also it'll be based on your financial goals as well, as far as what you're looking to accomplish.
So actually, this sounds very brainy.
Okay.
Sounds like a brainful meeting.
Mhm.
So is it difficult to buy insurance, or what I mean, I mean, I understand. I would imagine that people
Mhm.
come to you, they're a little concerned, they're a little confused, but
Mhm. Mhm.
does it take a long time? Is it, I don't want to use the word
Absolutely
easy.
not.
That's probably not the right word, but anyway,
Mhm. No, as far as saying that how long the process takes.
yeah, maybe that's probably better. Thank you.
So it's very simple. So when I'm sitting down with my clients, I take them through a 5-minute presentation. This is just talking about who New York Life is, how long we've been around as a company, and then we're going to transition to listening to you. I'm going to listen to what your family goals are, what are your business goals, what are your financial goals. I want to know what are those areas of concerns that keep you up at night. I want to know what are your number one financial priorities. And I want to know again, what are some things things that you like to do for fun? What does retirement look like from you? What does retirement look like for you? And then from there, once I'm able to listen to, again, your goals, what you're looking to accomplish, from there, we can design a plan right there on the spot. We could design a plan that we recommend that's going to be best for you. And if you think that's the plan that works best for you, you will have to do an application. So the application takes no more than 10 minutes. We're just going to ask you health-related questions, getting the pertinent information that's needed in order for us to get the application submitted. Once that's been submitted, you will do a telephone interview. This is going to consist of 15 minutes. Excuse me, I need to backtrack. Depending on the amount of coverage that you're looking for, if you're applying for, let's say, for example, you're applying for a large amount of coverage. Let's say you're applying for $1 million worth of coverage. The insurance carrier is going to require you to do a phone interview. Again, they're going to ask you questions. Are you into skydiving, thrill-seeking activities, things of that nature? If you smoke tobacco or if you smoke marijuana, things of that nature. How is your health? And then next, you have to do a medical exam. Mm-hmm. You schedule time with the medical examiner. It's going to consist of doing a urine and blood draw. And then once they get that, once we've done the blood draw and the urine exam, once we've done the phone interview, then next we have to wait for the insurance carrier to do their underwriting, have to do their due diligence, have to pull your medical records, have to contact your doctor for a statement of good health. And then you would know, and depending on how fast we get everything done, we would know if you've been approved for coverage in 2 to 3 weeks.
Well, that is good intel. So I know I've asked you, this is like, I hope it wasn't too painful, but I wanted to, like I said, provide the best information for our listeners so that they can make an informed decision. And that's really what we always try and do. There's a lot of information coming at people. And like I said, Google. I'm not advertising. I'm just acknowledging that I know it can get a lot of people in trouble. So I want to make sure that we go right to the source and get all the deets firsthand. So again, we can make the best decisions possible. So now that I have grilled you mercilessly, are there any closing remarks, or is there anything that I didn't ask that you feel is important that the listeners want to, that they should know in making these types of decisions?
Yes, what I would like to say is, people, if you already have an advisor that you work with, I encourage you to do annual reviews. We know things change, families grow, incomes grow, jobs change. We may want to start a business. We might want to start a business. Always sit down with your advisor, do annual reviews, and also continue to work towards your goals. And you can give me a call. I'll give my contact information once we're done. But yeah, I would advise you to sit down with your advisor and do annual reviews. We need to know where you are, so that way we can keep you under the direction to make sure you get to where you want to get to.
That is super awesome. And so shame on me for not saying that, but that is a good reminder, because life is not stationary, right? It's ever in flux, and good and bad things happen, and that we want to make sure that we adjust for those changes in our life, because hopefully you're not living under a rock somewhere. You're out there living the good life. That is what we espouse. We want you all to thrive and to be successful. So we also want you to take care of business. So again, that's why we have these little podcasts and videos on this channel, so that we can help you live your best life. So anywho, well, thank you so much, Mr. Jimerson. And again, please tell folks how to get in touch with you, because in case I confuse anybody with my unruly behavior, we want to make sure that they can go right to the source and get all the support they need. How can they reach you?
Absolutely. You can reach me on social media. I spell my name out for everybody. My name, it is Rafaниel. My first name is Rafael. Last name Jimerson, Jimerson. You can find me on Facebook. You can find me on LinkedIn as well. And you can give me a call. My number is 209-513-2725. I would love to have a conversation with you all. I offer free consultations, and let's build.
That is super awesome, Rafael. I cannot thank you enough. I had a good time, and I hope you had a good time. It wasn't too painful, and we will be sure and have you back. So thank you so much.
Absolutely, it's my pleasure. I appreciate you having me on this morning to talk to your audience. It's my first time doing something like this, so I very appreciate you.
Well, thank you kindly. So today's episode has been brought to you by Larissa Troach Real Estate. We are in a boutique brokerage providing educational and real estate resources to help you thrive. Thank you so much, and we will see you next time. Cheers.